Hello. I wanted to talk a little bit about job order costing. And let me go ahead and share the screen. Now, I've kind of worked an example here, but I kind of want to walk through this and talk a little bit about job order costing. Now, job order costing, um, one of the main points is looking at kind of the flow through the manufacturing cycle. And of course, job order costing is used whenever a product is basically unique, or you can kind of separate out the cost related to that product or that batch. So if you're building a house, if you're building a ship, if you're building a batch of t-shirts, you can basically separate the cost out specifically related to that batch. So, so a couple of things here. The T accounts we're looking at, you'll notice that they all are a T account and that they show debit and a credit side. Remember, the debit being the left-hand side, the credit being the right-hand side of each. And notice that we have raw materials inventory, work in process inventory, and finished goods inventory. Now, all of these are current assets on the balance sheet of a manufacturing company. And basically all of them describe the stage of production that a product is in. So raw materials would be the materials that come in that are waiting to go into production. Work in process would be the assembly line as to products being made. Finished goods would be the finished product that's been completed, that's waiting to be sold to customers. And basically cost of goods sold then would be where it would be transferred to. This basically is an expense on the income statement that represents the cost of items that have been completed and sold to customers. So think about it this way. If we complete a product, once it's complete, it sits in finished goods, because finished goods is the place that it's waiting to be sold to the customer. Once it's sold to the customer, it moves out of finished goods and goes to cost of goods sold. And then factory overhead, of course, down here represents factory overhead represents all of the cost of a product that are not direct materials or direct labor, all the manufacturing costs that are not direct materials or direct labor. So factory overhead would be factory utilities, it would be factory insurance, depreciation of factory equipment, indirect labor, indirect materials. It would be things of that nature would make up factory overhead. One other thing here, notice that we have the actual factory overhead is basically on the debit side of the factory overhead account, while the applied factory overhead is on the credit side. What happens with companies is when they're manufacturing a product, the actual factory overhead costs come in all during the month. And what companies want to do is they want to be able to go ahead and price their product as it's being made, put a cost on it, why it's being made, or when it's completed. And so what they do is they come up with a rate before the period ever begins in which to charge overhead. And basically they use that rate to apply overhead to the product as it's being completed. Otherwise, what they'd do is they'd have to wait for all the actual costs come in, and then at the end of the period, then go assign that to the products. So but they'd rather do it right when it's being made. So what they do is notice that they have the actual side, the debit side, where all the actual costs are charged to as they occur during the month, and the applied side, which would be the applied overhead based on the formula that the company has come up with, the estimated rate that the company has come up before the period ever begins. And what happens is then at the end of the period, they basically go in and reconcile this account to zero and make sure that all the actual costs were properly recorded. So typically it's pretty close between what's actual and what's applied, because the companies use their experience and their knowledge of the situation to come up with a good rate. So typically it's very close, but typically there's always a little bit of adjustment to do at the end of the period. So let's look at some transactions and kind of how they would fit in here. Now, one thing to note, I'll go back up here. You'll notice it's kind of a process here. Raw materials come in and they're waiting to go into production, and then once they get into production, they go into work in process. And then here also you see direct materials, direct labor, factory overhead are all added here. Remember that those are the three elements of product cost. Product cost is made up of direct materials, direct labor, and factory overhead. And so they're all added here at work in process. And remember, work in process is the assembly line. It's as the product is being made. And then once it's completed, it moves over to finished goods. And then once it's sold, it moves to cost of goods sold. So there's kind of a process here where it comes in at raw materials and then basically moves its way across until it's sold. So we're kind of looking at journal entries that will lead us through this process. And one thing to think about is you can use these T accounts to help you in this process. Think about it this way. Every one of these accounts are increased by a debit or decreased by a credit. So you can, every one of these accounts are on here. So think about it this way. If something's going into an area, you debit it. If something is going out of an area, you credit it. If an area is being increased, you debit it. If an area is being decreased, you credit it. And that's a rule that you can follow with all of these accounts. Now, let's look at some examples here. So let's say that company received raw materials for $100,000 on account. And so basically what we would do here is basically it would go into raw materials because we received them and we got them on account. So it would end up being a debit to raw materials and a credit to accounts payable. And notice again, and you'll notice all the way through here as we go. Notice that if it goes into an area or increases an area, you debit it. If it leaves an area or decreases an area, you credit that account. And that's the same true for all of these. So we notice we've got a debit to raw materials for 100,000. Now, what if we move $80,000 of direct materials and 2,000 of indirect materials into production? What would we do? What would the journal entries be? Well, notice that we would go over here and basically we would take 82,000 out of raw materials, 80,000 is direct and 2,000 is indirect. So the 80,000 that's direct would move over to work in process. And the 2,000 that's indirect would go to factory overhead. So basically our journal here, notice it's coming out of raw materials, it's going to work in process, and it's going to factory overhead. So we would debit work in process for 80, we would debit factory overhead for 2, and we would credit raw materials for 82. Where it's going is debited, where it's coming from is credited. That's a rule. Again, you're going to see that over and over as we move through this process. And notice the journal entry actually here as we go down. Debit to work in process, debit to factory overhead, and a credit to raw materials. Now, what if we incur direct labor cost of 45,000 and indirect labor cost of 10? So direct labor cost would be added into work in process. And indirect labor cost would go into factory overhead. So we would debit work in process for the direct labor, and we would debit factory overhead for the indirect labor. And so we would go down a little bit here, and we would debit work in process for 45. We would debit factory overhead for 10, and we would credit salaries payable for 55,000 here. Salaries payable is typically the account that's used, maybe wages or salaries payable. They basically are very similar accounts. So either one of those would typically be used here. Let's record factory utilities of 3,000 and factory equipment depreciation of 8. Now, both of these are factory overhead. They're basically, and remember what factory overhead is. It's all the cost of manufacturing that are not direct materials or direct labor. And so it's all the cost of having the plant that's not direct materials and not direct labor. And so factory utilities, factory equipment depreciation, both of these would be actual factory overhead cost. And so notice what we would do here. We would put the two of them to basically to factory overhead. They would be debited to factory overhead here. And then the other side of the transaction would be accounts payable for the factory utilities and accumulated depreciation for the factory equipment depreciation. One thing to remember with this process, if you're producing a product The only way for you to come up with your product cost is to charge all of the cost to the product. And so all of the labor and the materials and the overhead, all of that gets charged to the product. And as long as the company owns that product, it sits in inventory on their books. Now, once they sell it, then it's expensed as part of cost of goods sold. But that's the only way you can keep up with what the cost is for you to make a product, is to put all of the manufacturing cost to the product. Okay, so apply 22,000 of factory overhead into production. So let's basically go up here and remember that we have the actual factory overhead items as they occur during the month are all debited to factory overhead. But when we apply it, we're going to credit factory overhead. So we would credit factory overhead, and basically it would be debited then to work in process. So remember that since work in process is the assembly line, it's where the products get put together. This is the point where all three elements of product cost enter: direct materials, direct labor, and factory overhead. And so let's look at our journal entry. We would debit work in process, and we would credit factory overhead. Remember that we debit where it's going into work in process. We credit where it's coming from, so we credit factory overhead. So let's look at our next example. What if we complete $125,000 of product? So I would basically go up here, and if we're completing the product, it's moving out of work in process, and it's going to finished goods. So we would debit finished goods because it's going to finished goods. We would credit work in process because it's leaving work in process. So our journal entry would be just like what we saw it here. It would be a debit to finished goods and a credit to work in process for $125,000. We sell product basically costing $100,000 for $250,000 on account. So whenever we sell product, we're going to make two entries. One is we want to record the sale, and the other one is we want to record the item coming out of inventory. So we want to do both. We want to record the sale. We want to record the item coming out of inventory. So notice what we would do here. If an item is complete and it moves out of inventory, then we're going to credit finished goods because it's going to leave finished goods, and we're going to debit cost of goods sold. So notice again, looking at the D accounts up here, that once an item is sold, it's going to leave finished goods. It's leaving our inventory because we no longer own it. We have sold it. And it's going to move the cost of goods sold, which is an expense on the income statement. Remember, cost of goods sold represents an expense for the product cost that we produced. And as long as we own it, it sits in inventory. It's a current asset. But once we sell it, it moves out of inventory and moves over to cost of goods sold. Then also we would record the sale. And notice that this was a sale on account. So we would basically debit accounts receivable and credit sales or sales revenue for $250,000. Now, the last thing we'd want to do is we would want to reconcile factory overhead. And basically, if we're reconciling factory overhead, we would look at the factory overhead account. And notice here that our debit side has a balance of $23,000. If we add this down, we get $23,000. Our credit side is $22,000, and we applied $22,000 into basically the product. So that was what we applied to the product. So remember I said that there's always a little bit of a difference. It's typically close. We come up with a pretty good rate, but there's always a little bit of a difference here. So in this example right here, we have under applied because we applied less to the product than our actual overhead was. So what this means is if we were looking at this account right now, we would take the larger side minus the smaller side. And as of right now, we would be sitting here with $1,000 balance. we would have $1,000 debit balance, and we've under applied because we did not apply as much as actual. So in order to correct it, we want to credit factory overhead for $1,000. Since we have a debit balance, we want to credit it for 1,000, and that will take factory overhead to 0. And the offset account that we always use with factory overhead here is cost of goods sold. So if we look at the account over, if we look at the transaction over here, in order to correct this, we would basically debit cost of goods sold and we would credit factory overhead. So we've reconciled actual factory overhead charges with what we applied. And now factory overhead has a 0 balance, which is what we always want it to be. We want everything that occurred there to be applied to the product. Now, cost of goods sold is always going to be used as the other account to reconcile this. And we're always either going to debit or credit factory overhead based on the current balance in the account. We want to take it to 0. Now, one of the reasons we use cost of goods sold here is if you think about it, we apply factory overhead to the product. And as the product is completed, it moves on to finished goods. And as it's sold, it moves on to cost of goods sold. So all of our elements of product cost eventually work their way to cost of goods sold when the item's sold. So it would make sense that if we've not applied as much as we should have, or if we've applied too much, that the best place to correct this is just to put it to cost of goods sold. So it's always going to be the offset account whenever we're reconciling the factory overhead account. Now, only other thing I wanted to talk about is a little bit with the application of factory overhead, and I went ahead and put a formula down here. And that is that basically when we're coming up with the application rate, which would be the credit to factory overhead that we would apply to production, basically a rate would be that we'd take estimated overhead divided by the allocation base, which the allocation base is typically direct labor hours, machine hours, or direct labor cost. And so if our estimated overhead was 1,000,000, our direct labor hours were 20,000, then our factory overhead per direct labor hour would be 50. So if we put 5 direct labor hours into a product, we would take 5 times 50, we'd charge that product $250 of overhead. So typically companies do something like this to come up with a way to allocate overhead to their products. They would come up with this rate, and as the products are being made, this is how that would be applied to that product based on this rate. And one other thing I wanted to say is if we were doing a job cost sheet, which a job cost sheet is a sheet that keeps up with the cost of every job as it's being completed. So if we had product 101, we had direct materials of 2,000. We had direct labor of 5 hours at $30 an hour. So we'd charge it $150 of direct labor. And our factory overhead is 5 direct labor hours based on us using direct labor hours here in this example here. So we'd take 5 direct labor hours times the rate of $50 an hour. We would charge that product $250 of overhead. And our total product cost, again, would be our direct materials, direct labor, and overhead. So our total product cost in this case would be $2,400. So again, this is a good way to come up with, in this case, the cost of a job based on the job cost sheet. So this is all I've got for this process. But job order costing, a good way to keep up with product costs if you have a product that you can easily set aside the cost for that particular product or batch. Thank you and have a good day.